that young age, we both 28 at that time, that owning a house has more benefits than renting. So let me explain what is the 28-36 rules. For example, if you are struggling with financial strain, housing dilemmas, and the intricate dance of settling into a new life, it can often feel overwhelming. If you're navigating the complexities of marriage, new expenses, and the quest for an affordable home, it is very challenging and impacts our life and the lives of our loved ones around us. The challenges of financial strain, housing uncertainties, and the struggle to settle into a new family life affect countless individuals, particularly young families. It creates personal stress, it hampers the well-being and stability of families, it hinders their ability to thrive, it broadens societal implication. But in every problem, there is always a solution. Please allow me to share the 5 steps or actions we took when we first bought our primary house at the early time of our marriage and the early stage of our working career. If you are a young couple who is just starting a family, if you are a new immigrant who would like to purchase your home for the first time, and if you are an individual who has a goal to buy a house in California, the steps and tips from this video may help you navigate your journey as a first-time homebuyer. Welcome to our channel, The Legacy Life Mentor. I'm your host, your Global Tita Forlitz. Before continuing, please subscribe to my channel and click the bell button to notify you of my future content. If you found this content beneficial, please click the like button. If you want others to learn what you have learned from this video, simply click the share button and share the knowledge. And of course, click the comment button and give your insightful comments or what you have in mind about this video for our community to learn. Would you do that? Before we go through the process, I want to remind you that I am not a professional financial advisor or financial expert. All the information I provided in this video is based only on my experiences. You may need a professional advisor or expert before making financial decisions. When we bought our first house, we took 5 essential steps that have benefited us up to this day. Here are the 5 tips for the first-time home buyers. Tip number 1, clarify goal. Clarifying your goals when buying a house for the first time helps streamline the entire process, enabling you to make informed decisions that align with your priorities and preferences. We both agree that the main priority to establish a family is to have a place to live, a place that you will call your home. We ensure that we are precise in purchasing, not renting. We have always been a big fans of owning a house because my husband and I realized at that young age, we both 28 at that time, that owning a house has more benefits than renting. We both understand that owning a property is beneficial and positions you to advance your financial status. Why? Because of the following reasons: appreciation of property value, it has a tax benefit, it building equity, we have stability and security, we have control over property, and it also has a potential rental income and a legacy and long-term investment. Because this video is getting longer, we will elaborate on each of these benefits in our future video. Tip number 2, calculate affordability. We determined our budget for the house by calculating our affordability and considering our income, existing debts, and monthly expenses. Lenders often use the 28-36 rule, 28% of gross income for housing expenses and 36% for total debt. At that time, we had no idea what this rule meant, but we understood later with the help of professionals in this field. We were determined to have our own place then, so we just trusted the professionals and worked on the numbers they gave us. So let me explain what is the 28-36 rules. The 28-36 rule is a guideline lenders use to assess a borrower's financial eligibility for a mortgage loan. It sets limits on the percentage of a borrower's gross income that can be allocated to housing expenses and total debts. Here's a breakdown of the rule. Let's start with the 28% for housing expenses. According to the rule, up to 28% of a borrower's gross income should be dedicated to the housing expenses. The housing expenses typically include the principal, the interest on the mortgage, property taxes, homeowners insurance, and if applicable, private mortgage insurance or PMI or homeowners association, which is the HOA fees. This portion of the rule helps ensure that borrowers stay within the bounds of their income for housing costs. Lenders use this to assess whether borrowers can comfortably afford their mortgage payments without being financially strained. Let's talk about the 36% for total debt. The 36% limit applies to the borrower's total debt, not just housing expenses. This includes all recurring monthly debts such as credit card payments, car loans, student loans, and any other outstanding debts. The 36% threshold considers that borrowers have other financial obligations beyond housing expenses. By capping total debt at 36% of gross income, lenders aim to ensure that borrowers have enough income to cover all their financial responsibilities without excessive strain. For example, if a borrower has a gross monthly income of $10,000, the 28-36 rule would mean that their monthly housing expenses should not exceed $2,800, which is the 28% of $10,000, and their total monthly debt payments include housing expenses should not exceed $3,600, which is the 36% of $10,000. It is important to note that the 28-36 rules is general guidelines, and some lenders may have variation or additional criteria. Additionally, individual financial situations and local housing markets can vary, so borrowers should consider their specific circumstances and consult a mortgage professional for personalized advice. My third tips for the first-time home buyer is to assess your financial situation. Start with your credit score. Having a higher credit score is advantageous when buying a house for several reasons. Lower interest rate, better loan options, higher loan approval odds, lower down payment requirements, faster loan approval process, negotiating power, and overall cost savings. After the start of our marriage, my husband had an outstanding credit card balance of $12,000. Accumulated expenses from his school and from converting his parents' garage into a studio to having his own place to live. For the first 2 years of our marriage, we lived in this studio while working on our financial situation. Within 18 months, we paid off the existing balance. The formula is simple. We assess how much we can afford to pay the outstanding balance from our credit card. 12,000 divided by 18 months is equals to 667 per month, and that was our goal that we could afford to pay, and we focused. To maintain the 667 per month payment, no more or less, we needed to stop using credit card, so there was no additional balance to worry about. Living within our means and using cash on a daily basis helped us to accomplish this goal. To maintain the 667 per month payment, no more or less, we should reduce the interest rate charged to zero, so we did. At that time, multiple credit card companies offered a 0% interest rate for 12 months, but the catch is you have to pay off the balance before the end of the 12 months offer. Because the 667 monthly payment was based on an 18-month goal, we would need more time to pay off the balance without charging any interest on the outstanding balance. So, we transferred the remaining balance to another credit card with a 0% interest offer. We continued to pay the 667 a month without missing it and on time until the balance was zero. Now let's discuss about our savings. Another financial situation we assess is our savings. Having savings when buying a house is crucial for several reasons. We need cash for the down payment. We need cash for the closing cost, emergency fund, moving expenses. We also need cash to reserve for homeowners' costs, odds of improved loan approval, financial stability, and negotiating power. Having savings when buying a house provides financial security, flexibility, and the ability to navigate the various costs associated with home ownership. Our fourth tip for the first-time home buyer is to work with a real estate agent. Working with professionals at the very start of this process is essential. Why? Because they can provide valuable insights, negotiate on your behalf, guide you through the paperwork, help to get pre-approved for a mortgage, assist on exploring loan programs, research neighborhoods, assist with the process of home inspection, help us understand how the closing process works, guide us with legal and contractual understanding, and assist us in review contracts. Last but not the least, our tip number 5 is to stay informed. Educating ourselves about the real estate market is one of the steps we have taken to date because being knowledgeable helps us make informed decisions throughout the years, inform the complexity of the real estate market, updated with the interest rates, and any changes in regulations. Being prepared to buy our first house involves several steps, from financial readiness to understanding the home buying process. Let's summarize the 5 tips for first-time homebuyers. Number 1, clarify goal. Number 2, determine a budget for the house by calculating affordability. Number 3, assess financial situation. Number 4, work with a real estate agent. And number 5, stay informed. And that's it for today, everyone. I hope you learn and understand how to buy your first house from these 5 tips for the first-time home buyer. Take care, everyone, and thanks for watching.